Do you hold crypto, or are you considering investing in it? Well, you're not alone. In fact, there are some people sitting on billions, nay trillions of dollars in capital who are salivating at the prospect of investing in crypto. In this video, I'm going to tell you exactly why this institutional crypto accumulation cannot be ignored and what it means for all us retail investors. Stop. Before we commence, there is a disclaimer that needs to drop. From the top. Something that I am most definitely not is a financial advisor. That means that what you're about to watch is purely unsensational, educational, and informational content. If you are new, I don't mean to be rude. My name is Guy, that crypto YouTube dude. Over here at the Bureau, we produce the highest quality crypto content on the tube. News, reviews, coin overviews, market moves, anything you choose. If that sounds like your cup of tea, then appease me and tap that like button, please. Ping that bell as well to make sure the overlords at YouTube give you a ring when the next video is in. Anyways, enough foreplay. Let's see what these institutions have to say. The best place to start is to take a look at all the adoption that's been taking place on Wall Street. I'm talking about those, quote, masters of the universe, or vampire squids, depending on your point of view. Speaking of which, one of the most recent examples of this has come from the folks over at Goldman Sachs. About a week ago, it was disclosed that the bank had concluded a non-deliverable crypto option trade with Galaxy Digital. This over-the-counter trade was the first of its kind, and it's quite different from some of the other crypto trades that Goldman has done in the past. For example, last year it began trading CME futures, but these are exchange-traded, so there's no real risk to the bank from executing them. However, with these bespoke OTC deals, the bank is acting as a principal to the trade and hence has that risk on its balance sheet. So, quite simply, bankers are starting to get comfortable with this crypto market risk. According to Damien Vanderbilt of Galaxy Digital, quote, this trade represents the first step that banks have taken to offer direct, customizable exposures to the crypto market on behalf of their clients. Now, while the exact details of the trade, like asset, size, etc., were not disclosed, that's of lesser importance. It's the signaling that comes from this. It shows other firms on Wall Street that if Goldman is okay with executing such trades, why can't they be? The last thing that any of them wants is to be caught behind their competitors in a race for market share. Goldman, of course, wasted no time in bragging about this. That's because a few days later it added a crypto theme to its homepage and talked about the investment case for crypto and the metaverse. So, that's Goldman Sachs. The next big institution to have taken a bite of the crypto cherry is Bridgewater Associates. Now, for those who don't know, it is the largest hedge fund in the world. It has over $140 billion in assets under management, and it's run by Ray Dalio. He is one of the most prolific global macro investors, and he has recently been taking an interest in Bitcoin. Last year, he revealed that he had personally invested in some BTC. He's also been strongly making the case for Bitcoin as a safe haven asset and has even said, quote, cash is trash. Ray, I couldn't agree more. Anywho, what's really exciting is that about a week ago, his fund also announced that it had made an investment into crypto. More specifically, it will be backing a crypto fund, which will be an external vehicle. Much like the case with Goldman Sachs, this may not have a direct impact on the market per se, but what it does again do is act as a signal. If the world's biggest hedge fund is doing it, why can't your fund? I'll also add that Bridgewater released a report at the beginning of the year that analysed the evolution of this institutional crypto adoption, which I encourage you to read. That will be linked to in the description. But there's one more 500-pound gorilla that has also decided to add crypto to its diet. I am, of course, talking about BlackRock. Now, this is the largest asset manager in the world with almost $10 trillion in AUM. That's almost 7 times the size of Bridgewater, so it's a pretty big deal. If you've been following my Telegram channel and newsletters over the past year, you'll have seen me talk about this fund on a number of occasions. In those updates, I've been letting you know about the small steps that the fund has been taking towards crypto. Examples include some CME futures exposure last year, as well as job ads for VPs in digital assets. There were also individuals within BlackRock who were teasing out the possibility of the asset manager getting involved in crypto. However, it wasn't by any means an open embrace of cryptocurrency. Moreover, the CEO, Larry Fink, hasn't always been a massive fan of Bitcoin or crypto, and even said in the middle of last year that his firm has seen very little client demand for crypto. Yet, things have changed considerably over the past 2 months. Firstly, in early February, we had the news that BlackRock was planning to offer crypto trading services. This was according to 3 people familiar with the situation. According to this story in CoinDesk, one of the people said that this would be through BlackRock's Aladdin trading system. For those who don't know, this is one of the most widely used asset management platforms in the world. It's used by everyone from Vanguard to Apple, Japan's government pension fund to Google. Almost $20 trillion worth of AUM was disclosed on the platform, and that was back in 2017. I'll leave a link to this FT article in the description which lets you know the true scope of it, but the point is that any Bitcoin trading integration here would be a big deal. I mean, just imagine the implications of a platform that would easily allow managers with over $20 trillion in AUM to effortlessly buy crypto. Of course, these were just rumors at the time, but you can be sure that if BlackRock got enough of its clients asking for crypto trading services, it would look to integrate them into the software all its clients use. It's only logical. Moreover, while Larry Fink wasn't too convinced about the demand for crypto last year, he has also changed his mind. That's because last week he released a letter to shareholders, which was the most definitive sign yet that BlackRock is positioning to provide crypto services. Not only did he explain that client demand for these services is growing, but he also made a pretty good case for them as an asset class as well. This was in the context of the conflict in Ukraine and the resulting sanctions. Basically, it's exposed the risks of currency dependencies. This is something that I talked about in much greater detail in my video last week on the implications of the sanctions, and that's linked to in the top right for you to come back to later. Now, I've just been speaking about some of the biggest and most recent examples of this adoption on Wall Street, but there are plenty more examples out there. Here is just a short list of TradFi players who are either providing crypto services or investing in crypto. Citadel Securities has been investing in crypto companies. Brevan Howard is starting a crypto hedge fund. Hudson Bay Capital Management has seen growing profits from investing in crypto. Investment bank Cowen is launching a dedicated crypto division, and so on and so on. Indeed, these high-profile cases are just the ones that you hear about. There is significant market evidence out there that shows accumulation by whales, too. I want to start with this report by the folks over at Into the Block. What they've done over here is a chart which shows the share of Bitcoin transaction volume that is comprised of what are termed large transactions. These are basically all transactions that are over $100,000. The reason why these can be thought of as institutional buys is because it's less likely that retail investors are buying Bitcoin in such large quantities. Anywho, based on current stats, it shows that over 99% of all the transaction volume was for these large trades. This is up considerably since mid-2020, when we were sitting at about 85% of the volume there. And since that time, it has remained considerably above the 90% mark. Then, to add to this, you had the annual shareholder report that came out of Coinbase. I'll leave a link to it below, but what I'm really interested in is the distribution and growth of the trading volume for retail and institutional clients. As you can see over here, in 2020, Coinbase had trading volume of over $73 billion for retail and $120 billion for institutions. However, in 2021, these numbers stood at $535 billion and $1.1 trillion, respectively. That means that while retail trading volumes have grown by about 7.3 times, the institutional volume has grown by almost 9.5 times. You can find further proof that this institutional drive is happening on the Coinbase exchange thanks to some on-chain data. Over in this report by the folks at Glassnode, they take a look at the impact that the low levels of short-term supply are having on the market. They basically examine the Bitcoin balance on Coinbase and how it has evolved over the past 4 years. As you can see, with the recent fall in March, the balance stood at just below 650,000 BTC, which is almost 37% lower than the peak balance that we saw in April 2020. It's also worth noting that we've not seen Coinbase balances this low since December 2017. As Glassnode points out, quote, as the largest exchange by BTC balance and a preferred venue for US-based institutions, this further supports the adoption of Bitcoin as a macro asset by larger institutions. So, that's on-chain data coming from Coinbase. However, if you wanted to get a picture of broader address distribution, then this chart by the guys over at Econometrics is quite illuminating. Basically, it shows the change of the amount of coins held in aggregate for all those addresses that hold between 1 and 10K in Bitcoin, i.e. the whales. What you can see over here is that in the past 3 months, the whales have been accumulating as the amount of coins held in these addresses is growing as well. As they conclude in their tweet over here, this shows that despite the current prices and volatility in traditional markets, these whales still feel comfortable adding Bitcoin to their stacks at these prices. Okay, so that's the data to back up the headlines. But the broader question now becomes, if this wave of institutional adoption is indeed taking place, is it really a net positive for the crypto markets? I mean, yes, it's price positive, but what are the long-term implications of this redistribution? The main reason why Bitcoin was created was to free us from the constraints of traditional finance, the kryptonite to the CeFi Antichrist. And now it seems as if we have opened the gates and let the Trojan horse roll on in. Well, the sad fact of the matter is that for cryptocurrency to really achieve mass adoption, the centralized financial system has to be comfortable providing services to the sector. As much as we don't like to admit it, we are still reliant on these on- and off-ramps. For those of you who've been in crypto for some time, you'll no doubt know the difficulties one used to face when it came to banking and other services. However, given that these banks and financial service providers are now themselves offering cryptocurrency services, they should be a lot more amenable to people like us. Apart from the general access to financial services for crypto users, you have the generally improving market conditions. While crypto is still a hell of a volatile asset, there's no denying that the volatility that we face today is a mere fraction of what it used to be. This is thanks to the liquidity that comes from all that institutional volume and market-making ability. Larger Bitcoin buys can be absorbed with ease and have relatively little impact on the price. This also means that it's harder for whales to manipulate the market by executing large transactions, practices that were quite common even up until 2017. Liquidity also brings with it price discovery and generally more efficient markets. Whereas in the past you would have large price discrepancies between different exchanges and trading platforms, today these are almost non-existent. This is all thanks to the algorithmic execution that makes up a large component of institutional trading. This reduced volatility is actually something that helps to further the general adoption of crypto as an alternative currency, something that I'm sure we're all in favor of. Now, apart from the improvements in market conditions, the billions of dollars in institutional money that's being invested in the space is helping to advance the technology, to make it more usable, more scalable, more amenable to adoption. Unfortunately, we have reached a stage in the life cycle of cryptocurrency and blockchain development where we can no longer just rely on open source contributions to take the tech to the next level. This is where massive development budgets come in. And finally, one more benefit of the adoption of crypto by these institutions is that we're less likely to face unfriendly regulations from governments. Love it or loathe it, these financial institutions have got a line in to all those politicians. They have their ear thanks to the massive amounts of lobbying money they're able to throw around. Given that these institutions are making money in the space, they're also eager to ward off any sort of regulation that could kill the cash cow. It could evolve into a weird reality where the likes of Goldman Sachs, for example, could be an unlikely ally in the war against the overzealous politicians. As they say, the enemy of my enemy is my friend. Now, I'm under no illusions that all of these institutions have our best interests at heart. Indeed, I'm concerned about some of the risks that come from them, including that of increased centralization and control. But it's also important to be pragmatic about what's required for the advancement of the industry that we hold so dear. The playground is big enough for both us and the institutions. So that's the case for the adoption. However, is there one more frontier for institutional adoption? One that already appears to be on the horizon? There sure is. We've so far taken a look at adoption by the likes of banks, hedge funds, and asset managers. However, the institutional landscape is much, much bigger than those three players. For example, when it comes to AUM, no sector could ever compare to the sheer amount of capital that's tied up in global pension funds. According to this recent report by the OECD, there is over $50.6 trillion tied up in these pension behemoths. So the natural question is whether they are ever going to consider crypto. Well, they certainly are. And not only that, but some have already started investing in crypto or companies within the sector. On the actual coin side, you have the likes of the Houston Firefighters Pension Fund. Towards the end of last year, it disclosed that it would be investing $25 million in Bitcoin and Ether. Not a massive amount by institutional standards, but baby steps with grandpa's gains, huh? It was not alone last year. You also had the likes of the Virginia Public Pension Fund that invested almost $50 million in a crypto fund called Parataxis. Now, some of the biggest pension fund purchases from last year were for private placements in large crypto companies. For example, in Canada, two of the country's largest public pension funds have taken part in these funding rounds. In Quebec, CDPQ invested in Celsius's latest round, which valued the company at $3 billion. Then, the Ontario Teachers Pension Plan Board decided to take part in FTX's latest funding round, which valued the exchange at $25 billion. No, these are not investments in actual cryptocurrency, but the fact that they're investing in crypto companies shows that they are bullish on the sector and its long-term success. Now, beyond the pension funds, we also have university endowments that have started to edge into crypto too. Last year, according to a report, the endowments of Harvard, Yale, and Brown all had Coinbase accounts and they had made cryptocurrency investments. The exact specifics of the investments aren't known, but the fact that investors of this caste thought that crypto was a worthwhile long-term investment is bullish in and of itself. But the institutional investor landscape extends beyond just TradFi titans, pension funds, and endowments. It also includes those asset allocators that operate at the behest of sovereign nations. That's right, sovereign wealth funds are tasked with preserving the cash of governments, and they are flush with it. And while there has yet been no recorded crypto investment by any sovereign fund that I could find, it has been reported that Binance has been in talks with these entities as part of its ongoing funding talks. No funds have been named, but according to CZ, quote, the ticket size involved will not be small. It won't be a short process. It'll be interesting to see whether we're likely to see any of these funds make investments into the crypto space. Total speculation on my part, but perhaps one of the sovereign funds in the UAE could be interested in crypto-related investments. We know that the UAE is trying to make itself a crypto hub, and last year the CEO of Mubadala, the country's sovereign wealth fund, was making positive overtures towards cryptocurrency. So, that's sovereign wealth funds, definitely one to watch. However, there's one more class of investor out there that is primed for crypto adoption, one that has been so far ignored, and that is central banks. Now, hear me out. I know that the notion of the backers of the fiat money system investing in crypto is not to everyone's liking. However, foreign central banks have to hold currency reserves, and they have to pay very careful attention to what currencies are in their baskets. That's because the value and, most importantly, ability of these banks to access these reserves to protect their mandate is essential. However, As we saw last month, the mere ability to access foreign currency reserves cannot be taken for granted. That was thanks to the actions that were taken against the Russian central bank, which saw over 60% of its FX reserves frozen in the wake of Russia's invasion of Ukraine. There were also attempts to seize the gold being held by the bank at vaults overseas. But the TLDR of these actions is that central bankers around the world are seriously considering whether USD reserves are as safe as they have been made out to be. Beyond even that point, when they hold USD reserves, they hold an asset which is depreciating at a rate of over 7% a year, thanks to inflation. Essentially, these foreign central banks know that the value of their reserves are driven by the actions of another central bank, the Fed. Sure, they can diversify into other hard assets like gold, but this is not always practical. As mentioned, other countries can seize this, and it's also become that much less effective as an inflation hedge. So, could a central bank conceivably invest in Bitcoin? Well, yes, I think so. Secure, easy to move, impossible to seize if properly custodied, and appreciating year by year. And the more countries that start adopting Bitcoin as a legal tender, the more likely central banks are to view it as an actual currency, and hence one that can form part of their FX reserves. More about that in the description. Okay, time to leave you folks with a few of my final thoughts. As I've shown, this institutional adoption is one of the strongest driving forces behind that accumulation that we've been seeing over the past 2 years. Hedge funds, asset managers, bankers, and VCs. They are all falling over themselves to get a piece of that crypto pie, and they are loving the taste of it. Despite what many of us may think about these players, we cannot deny that their involvement in the space is helping to make crypto more adoption-friendly. More liquidity, less volatile markets, more access for all, and the prospect of pro-crypto regulation. Of course, what we've seen is just the tip of the iceberg compared to the capital that lies below the surface. There are numerous investor classes out there that have been holding off on their investments until the moment is right. Until regulations are clearer, liquidity is better, and volatility less, volatile. Well, that virtuous institutional cycle of adoption and its ancillary benefits is well underway. And numerous pension funds, endowments, sovereign wealth funds, and yes, even central banks may be waiting in the wings. All you need is a certain critical mass, a turning point at which merely waiting could be too costly a strategy. Some say that turning point is still far away. Others think it's just around the corner. What do you think? That's all today from this Crypto Bro, but I'm really keen to get your feedback. So, what do you think of all this institutional adoption? Could we ever see a sovereign fund or central bank make moves in the crypto space? I'd love to know, so fire those comments down below. Also, while you're down there, I have something extra special for you. It's my dedicated socials page, which has all the official links to the following: my Telegram Insider channel with daily market analysis, Twitter for the latest from the Bureau, Instagram and TikTok for behind the scenes, and finally, my weekly newsletter. Now, it's here that I share my crypto tips as well as a breakdown of my personal portfolio. So be sure to find that page if you want all that good stuff. Now, if you guys liked this guy's vid, share the love. Hit that like and tap that subscribe. Ping that bell as well for good measure. You don't want to miss what else I have coming. I hope to see you all in my next video. Till then, stay strong, stay safe, and stay crypto. Cheerio.